All right, ladies and gentlemen, I hope you had a wonderful day. We had another wild day in 2024 with the market gapping down and then melting up towards the highs. And as much as I want to give you a recap of what went down today, there really wasn't that much as we are in that dead space leading into the CPI and earnings. Now, the good news, there is one catalyst tomorrow, the 10-year bond auction at 1 p.m. Eastern that may give us an effect. Otherwise, the day after that, that's where everything takes off. And so I'm going to use this video to give you another tutorial, and I want to go over how to trade volatile stocks and ETFs at a discount. Now, I will be using the Mara stock. This is a crypto-related stock, and it's one of the best examples I could use right now. And honestly, it's very timely considering that Bitcoin ETF approval should happen tomorrow. But I really do hope you can learn something from this video, and whatever happens the rest of this year, if you see any volatile names, I hope you could use this strategy to protect yourself. So what I need from you, a thumbs up on the video, make sure you're subscribed, and if you don't know, we are live Monday through Friday, 30 minutes before open, youtube.com/thestackmarket. We will see you there in the morning, baby. Run it.
Working to the couch, it's the 2020 less. Live in the hills, but still get a spread. Started with a live, but I still reinvest it. Feel how I feel, then you feel like a blessing. I just want the lesson, I just want protection. I'm up and I'm down, but the sound like progression. Farming never plans if he waits for perfection. Finger to the down.
Right off the bat, ladies and gentlemen, we're going to start here with getting familiar with Mara stock. This chart right here is the actual stock. When you hear me talk about premium, that is the option chain over here. Now, I'm going to do this tutorial a little bit like the one I posted last week. If you missed that one, it was how we turned $600 into about $7,000, and that one we were going over the options. In this tutorial, we are going to be going over both stock and options. The strategy that I'm going to show you today, it requires using both. So we're going to have a little bit of chart action. I'm going to jump here to the keys. We're going to go over a lot of words, and then I'm going to jump back to this so you could see a live example. I didn't make the trade, but it should get you familiar with the whole entire strategy. So what we're going to be talking about here is covered calls, but not your traditional covered calls. It is going to be for swing trades and plays that you want to flip, but the real number one thing we are looking out for is hype. That's the reason why. You go take a look at Mara. There's a lot of hype surrounding the stock, all of the Bitcoin stuff, and if you got to take a look at it, this stock just a couple of months ago as low as like $6, $8, went as high as $30, and right now it is chilling at $25. So let's get to the first key and understand the number one thing. If there is hype, there is going to be premium on that option chain, and you can use that to your advantage. The obvious risk of going about trading something like this, when you see a chart like this, it's like, whoa, well, yeah, I want to get in on the hype. I see everybody getting involved. What should you be worried about is if you buy this stock at $25, if something bad happens, if crypto goes down and this drops down to $12, $6, you can lose 50% way faster on a name like this than you can on a normal stock. Even NVDA, you would have to have NVDA go down to like $200 if you wanted to lose 50%. That is the risk to reward with hype names like this, especially a lot of these crypto names. So that's what you have to understand. And the number one thing with that is that you can protect yourself when a stock is up a lot by protecting your downside. It doesn't matter if the stock's been hyped up a lot. If you have a way to protect your downside, you could at least have a little bit more of an edge in terms of holding it, riding it out, and letting it do what you want. Or even if there's a big move you want to get in and out, you still want to think about your downside. And I'm not talking a stop loss here. So how do you go about doing that? It is by getting a lower cost basis. So this is where it gets very interesting because you can lower your cost basis through many means, by dividends, covered calls, selling puts, but in general, your cost basis, it is what you paid for the stock. That is your position. That is where you are positioned on the chart, on the scale. If the stock is going up a lot or it moves a lot in a single day or a single week, you want to have a lower cost basis. So how can you do that when a stock is still high? You can buy the stock for a higher price and still lower your cost basis. And the best way to do this, especially when there is a lot of hype on a stock, and what do I mean by that is when a stock has moved up 20, 30, 40, 50% in a short amount of time, that's a lot of hype. What you can do is sell a call option immediately when you buy the stock. Now, you've seen me do this before. I've done this in the past. In 2020, we had a play where the stock was up a lot. It was SCO. It was relative to oil, but the stock and oil was moving so much that the options were almost as much as buying 100 shares. Even if you saw what I did with Rite Aid, I got clapped on Rite Aid, but guess what? I would have lost an extra $20,000 if I did not use this strategy, and this is what I go about doing. When I see hype, if I really have an idea and I want to play it, I buy this stock, and then I look for an option to sell. So I'm going to show you an example here in a little bit, but obviously there has to be some downside to this. So if you don't know about options, you're not familiar at all, I really encourage that you paper trade, and none of this is a recommendation. Option trading stock market is extremely risky. You can't lose almost financial investment because whole financial advisor, educational purpose only. Thank you. Have a wonderful day. But in all seriousness, you can lose a lot with any of these strategies because when there is a hype play, when it is low liquidity, if that thing turns against you, it will put you in a world of hurt. Again, I lost a ton on Rite Aid. I did use this strategy to buffet the losses a little bit, but at the end of the day, if something gets really out of hand, you can still lose a lot. By using this strategy, it is not going to guarantee that you are going to win every single time. So if anything, what I can guarantee with this strategy is that it will cap your gains. So here's the deal. By selling a call right when you buy a stock, especially a hype trade, you are selling a call and agreeing to sell the shares that you just bought at a higher price. So that price that you sell on the strike price, that is the maximum amount of money that you can receive on the play. So that's the downside, but what is the good side? Your break even on the play, your cost basis will be dramatically lower if you do this right. So if you're playing a hype trade, why is this not good? Because the stock could go crazy. It could even go past the strike price that you sell out, and you end up making less money than you would have if you just bought the play, did not protect your downside, and then just went in full send on all of it. So that's the first downside. The other downside is that if the stock craters, you will still take a loss. This isn't going to stop you from losing money on the play, and then even worse, you might be tied to the play for a little longer. So if you want the flexibility of get in, get out, get in, get out, get in, get out, and you don't really want to focus on a play, you move on very, very quickly, awesome. This strategy may not be for you because the idea is if we are selling a call with the stock that we're buying, options have a time limit on them, and we will talk about how you could finesse this, but in general, you will be tied to this stock for a little longer. Not as long as you think, but definitely you're not going to have the same flexibility because, again, if the stock goes down, you will lose money on the equity, you'll make money on the option, but it still might put you in a position where net after all of it, you still might be negative and you can't take a W off of that. So that's the first big thing. Now let's get into the option chain before we hop back to this document here, and I want you to see what I'm talking about. I'm using Mara because, quite frankly, it's a really good example. It's moved up a ton. There's a lot of hype, and then there is even a catalyst coming into the next few days. So right now, this stock is trading at $25. If I was going to do this, I would be buying 100 shares of this stock at $25.15. So $25.15 times 1.5, I almost messed that up, times that by 100, that is $2,500 that you are spending for 100 shares of this stock. Then what I would do is go to the option chain. Like I said, you buy a stock, then immediately go to sell a call. The option we're going to be using today, and I know some of you are going to have questions about it. That's what the document still has in it. I'm going to be selling the January 16th, 2026, 2 years out, the $45 calls, and if you see on the bid, they are going for $12.30. You may even be able to get a little bit more. Somebody bought them for $12.85, but we'll just use the bid price. So if you sell one of these options for $12.30 on an option chain, that will give you $1,230. So minus that $12.30 from what you paid for the stock, you now spent $12.85 for 100 shares. If you want to understand that in share terms, here's the easiest thing you can understand. You see this stock price right here of $25.15. Take the $12.30 and simply subtract that, and that will lower your cost basis. Literally, $25.15 minus the $12.30 that we would be selling the option for, that's going to leave you with $12.85. Times that by 100, that is now your new risk. And guess what? Even though you bought the stock today at $12.85 or $25.15, and by selling that call option, your cost basis is now down to $12.85. So take a look at the chart. That's both good and bad. It does get you positioned literally right before the run-up even happened, but you could even see there's still a little premium. You can still lose 50%, maybe a little less, if it does absolutely get wrecked and come back to some of these lower levels. But this is what I want you to see. You don't have to do this on just Mara. There's a lot of different plays. You can even do this on NVDA and other stocks, and it's simply the same exact strategy. You go, let's say NVIDIA, you want to buy NVIDIA, it's at 532.65. Go down here, let's say we'll go to the furthest one, and again, wherever you choose to sell the option, that is where you're going to be capping your gains. You simply look at the price of the stock, NVIDIA 532. If I sell this option for $44, it is going to lower $44 and then put you cost basis wherever you are after that premium is subtracted. So some stocks it's better than not, but like I'm saying, these small caps and plays that have ran tremendously and had a lot of hype, you're going to be able to take advantage of the high premium and make a lot more. So before we get back to the document, the only one thing, because I forgot to explain it here, by selling this $45 contract, getting our $12.30, bringing our cost basis to $12.85, remember that downside we are talking about, you're buying the stock at 25, selling the premium, your new positions here at like 12.85, but by shorting the $45 contract, selling that premium, your max gain is $45. That means you could only make the difference between $25 and $45, which is still $20 a share. In this case, that is almost 100%. Not too bad. So hopefully you guys get that. But now I'm sure a lot of people are like, Josh, why are you selling years out on the chain? Hold on. Why are you selling years out on the option chain? You have to hold it for 2 years now. No, you don't. If the stock dies, that premium will die in a couple of months. It may take a little longer than if it's not going to happen in a day or two, but you've seen me do this. Even Rite Aid, I got out of that play well before 2 years, and I got 90% of the premium. It's because with these hype names, and now the stock has moved up to a range it hasn't been at. You know, again, Mara was just at $6. Now it's at 25 or 30. Yeah, it could hold these premiums for now, but if it really does come back to normal, these contracts aren't going to have a lot of money. Let a little bit of time go down and you will watch that thing decay relatively quickly. If you sell it high enough and you take advantage of this, you could get 50% or way more relatively quickly. And this is what I'm trying to teach you, because why do I go years out on the option chain? What is the whole point of this strategy? We want to take advantage of the option chain and sell premium. When there's a lot of time, there is a lot of premium. That way, it's allowing us, think about the example I just showed you. You're able to buy the stock at 25, have a max reward of $45, and still protect yourself to the downside. But think about it, by selling way far out, that's what's giving you a lot of money up front, giving you a higher strike price to give you some wiggle room, and you are taking advantage of people forecasting that what happened in the short term is going to keep happening over the longer term. And usually with options, how many times have we seen that happen? So obviously there is moments like even NVIDIA leaps last year, they go crazy, but for the most part, this is where I like to go on the chain, because I like to take advantage of the premium. This is what I even do on my normal covered calls on the long term. So that's what I want you guys to understand. And here's the final pro tip that I'm going to give it to you. I told you, you could do this on other plays, but here's the best part. This works very, very well on ETFs that have a lot of hype. Think about Argentina, think about even Brazil or even India. When there was a lot of drama with everything going on just even last year, when some of these ETF or country ETFs have a lot of things going on, the ETF premiums will shoot up in the short term and then they will eventually level out because ETFs don't move a lot. But this is how you are able to take advantage again of higher premium, higher time, buy the stock, get upside, lower your cost base, basis. And then once that premium dies down, either the stock will go with it or maybe it stays stable, and then you're able to profit immediately off of that premium. And the other instance is commodities. Think about what happened with wheat. Think what happened with corn, with oil. We did this before. I've done this play at one point where I got paid more for the option than the stock. So if you don't understand what I'm saying, I was able to buy SCO for like $25 a share. I spent $2,500 for 100 shares, and I went out on the chain, and I was able to sell the premium for almost double and collect back more than what I spent on the stock. These are some of the inefficiencies that happen. Remember, stock market is separate from the options market, and that's why I want you guys to be aware of this, because, hey, maybe you see a hype play, you want to get in on it, or even in the moment of reacting to the news, you could go for shares and sell an option and see how this balances out. So hopefully this helps, and like I'm telling you, there is downsides to this strategy. It's not going to guarantee you anything, but this is definitely another thing to add to your tool belt, and I want you all prepared. But that is your watch list tutorial. Make sure you guys are hydrated, healthy, ready to go. Make sure to post your watch list. Make sure we see you there in the morning. I need the armor on. I need the helmet shining. And Chad, I need you to be hungry, baby. Don't ever lose that desire and hunger. I'll see you in the morning, and for this CPI breakdown tomorrow, and horn.